Welcome to Capital Decanted. In this show, we say goodbye to tired market takes and superficial sound bites. Because here, instead of skimming the surface, we dive into the heart of capital allocation, striking the perfect balance and exposing the subtleties that reveal the topic's true essence. Prepare to have your perspectives challenged as we open up the issues that resonate with the hearts and minds of those shaping capital allocation. We've enlisted the wisdom of visionary leaders in the industry, and just like a meticulously crafted wine, we'll allow their insights to breathe, unfurling their hidden depths and transforming our understanding. This is Season 1, Episode 6 of Capital Decanted. I'm John Bowman.
And I'm Christy Hamilton.
And we are your hosts. A huge thank you, as always, to our Season 1 title sponsor, Franklin Templeton Alternatives. With over 40 years of alt investing and $260 billion of assets under management, they've assembled and offer specialist investment managers across 6 different asset classes: private debt, hedge funds, real estate, infrastructure, private equity, and venture capital. And of course, all of them operate with the client-first mentality that has always defined Franklin Templeton to prioritize investment outcomes. Thanks so much, Franklin Templeton Alternatives. Well, our first episode last September, which, Christy, seems like both yesterday and 5 years ago, tackled the emotionally charged topic of private market valuations, you might remember. And we posed the question at the time: are quarterly marks reflective of fair value, or are they imaginary machinations of the GP? And I said the following in my opening. I said, quote, "Traditionally, it's common knowledge that at the American Thanksgiving dinner table, it is taboo to discuss politics or religion. Perhaps we should add private market valuations to this list of toxic topics that inevitably result in vitriol and misunderstanding." In our inaugural episode of Capital Decanted, we're going to lean into this divisive and complex topic. But as the identity and purpose of the show promises, we will neither shy away from a healthy, comprehensive debate nor resort to juvenile attacks. End quote. So in retrospect, and after many hours of prep over the holiday season for today's episode, private market valuation seems like child play at this point. It's a playground skirmish at recess compared to the intense battleground that is today's topic: private market regulation, and particularly the new Private Fund Advisor Rule, or PFA, as it's sometimes called, that was announced by the SEC in August of last year, 2022. I want to first provide, before we get to the agenda of today's episode, a couple disclaimers on our posture, our identity here, CAIA Association's posture and identity here, and Christy and I's posture and identity. Because that's the sensitivity that I've just described and the inevitable and healthy reality that our listeners and members are going to have various views on this really, I think, requires these disclaimers. So first, CAIA is a professional body. And those aren't just words. They are a reflection of our stated mission and our anchor of purpose. We exist to improve investment outcomes and raise ethical standards of capital allocation because we believe passionately that a transparent, fair, and properly functioning capital market system is the engine for delivering pension benefits and individual retirement goals, as well as preserving university, foundation, and sovereign savings. We're here to steward a profession. So why am I opening with this high and mighty reminder? Because I think the layperson market participant, at least in my experience, understandably doesn't understand the differences of many of us attempting to lead and advocate and speak for the industry. More precisely, CAIA is not a trade association or a lobbying group. These are institutions funded by a certain subset of the industry with the aim to represent their interests to government and regulators. So our good friends and often partners at AIMA, MFA, SBAI, AIC, ILPA, they're all great examples of trade groups. They exist to protect the interests of a certain stakeholder by being their collective voice. We exist to protect the interests of the greater good and the larger capital market system. What this means is that given our mandate and mission, we will sometimes end up on different sides, or at least have more nuanced views of issues than these trade groups who have a more narrow and focused agenda. And I can't stress how critical it is to understand that perspective and motivation going into debates like this. It doesn't make either of us wrong or right, the good guy or the bad guy, but it does necessarily often lead us to different conclusions. We serve different masters, and that's okay. And that leads me to my second disclaimer. Just like with private market valuations, while we do have views here, and Christy and I will be open about those views here on Capital Decanted, we will always endeavor to represent alternative views fairly and respectfully. I leave that to you all to determine whether we've balanced that civil disagreement in a manner worthy of our intent But as I've often said, nuance is the adult form of dogma. And this is an issue that is as far from black and white as any we've tackled. So a little bit of balance is critical. So with those disclaimers behind us, I want to start with you, Christy. As a former LP in particular, did this preparation energize you, strike a nerve, trigger PTSD? How did you weather this prep?
It's funny, the PTSD just made me laugh. But it's weird because I've never gotten overly emotional when it comes to investing, and definitely not frustrated, because basically 2 decades in the industry has taught me that when you are a fiduciary on behalf of a unique mission-focused organization, there are some issues with your investment advisors and partners that you can get past and you can get comfortable with and work through. And there are some you just can't. And I think it's on you as the professional or the professionals out there listening to be able to discern the difference. So I don't get frustrated or upset. I just recognize that the GP has a business interest and I have an interest as the provider of capital. What has absolutely surprised me in this discourse is that this topic and how it's discussed in the aggregate right now is so different from my lived experience committing capital with GPs. And I say that because I get the sense that there's a lot of pushback right now from the private fund side and from the advisor side, basically saying, this is going to end us. This is going to be so overly difficult. But a lot of the stuff that's requested in the rule itself, I have asked GPs for, and they have willingly given it to me. And I can't think of a time that I went to a GP that we had partnered with and we had committed capital to that was unwilling to work with me on some level to get me the fee information that I needed or requested or was looking for. So again, it's this odd dynamic between what's being said in the aggregate about the GP versus my experience with quite a few GPs being really great and wonderful partners. So I think that that's the main disconnect. And I will add, it's interesting because the rule itself is a lot of pages. It's hundreds of pages. And I know that because I read the whole thing. And I actually highly recommend that at the very least, if you go to the SEC website, there's a Cliff Notes version. And then also the first opening pages are actually really great because they give a lot of industry information that we as professionals were constantly looking for. So I just want to put that in as a tag to say, go actually read the rule or at least parts of it. But I think closing, John, in your actual question, I think overall my views on this, to your point that you just made, they're complicated. So I have core values around transparency and openness and partnership that are integral to how I think about the investment world. So again, at the highest level, I completely agree with exactly what we are as an industry are asking for. And I want to add, anybody who knows me will laugh at this because I'm not a laissez-faire free market capitalist. I think regulation is important, but I'm also highly skeptical of regulation. And I will say at the very least, all of this really shouldn't have been a surprise. I think it's really funny how surprised people are, but I listened to about 8 to 10 hours of Gary Gensler testimony, both recently as the SEC chair and then a decade ago as head of the CFTC. And you can make a drinking game out of how many times he asks for more money because we need cops on the beat to regulate industries. And we're talking about a leader who did seek to drastically expand regulation of over-the-counter derivatives back in 2009 under the CFTC, which a lot of people had a problem with at the time. And this is also, I didn't realize this, but he was actually senior advisor to Paul Sarbanes and was integral to writing Sarbanes-Oxley back in 2001. So it is a man who has clearly devoted the latter part of his career to regulation. So to be surprised that he's coming in strong against privates and he's coming in strong against crypto and a lot of the other things that they've had on their plate this year is funny as well. So that's my 2 cents at the moment.
Listeners, this is why Christy is such a good compliment to me, because the idea of 8 hours of Gary, no offense, Gary, if you ever listen to this, or reading through hundreds of pages is just not my jam. I'm going to make Madonna really proud now. It is a Cliff Notes world, and I'm a Cliff Notes boy. There you go. So it got me through college, and I'm going to continue with that. So for me, it was interesting. The culture episode 4, was the most natural or easiest for me, I think I mentioned. The wine episode 5, was the most fun. This one was by far the most challenging and maybe sobering so far. And I realize we've only done 6 episodes here, but first, that's because it's really technical and multi-layered, and I certainly don't have that expertise, as I'm half joking about. So to provide a practical guide, a layperson's framework for how to think about this and form your own opinions, which is why we're here, that's always our aim on this show, it's really tough. And then it was hard because of all the sensitivity I just mentioned and disclaimed. I've got friends, as you do too, and professional acquaintances all over the map on this thing. It is far from simple, and smart folks can take opposing views here that are not personal at all. And we've really tried hard to work to navigate this with empathy and understanding, and that's just not easy. So again, we love your feedback on whether we threaded that needle. So here's the agenda for this episode. I'm going to cover three main topics in my segment. First, a brief retrospective on how we got here, given that the near century-long regulatory precedent of exemption and light touch oversight of private funds has endeavored this entire time. And perhaps that's why this is playing into the contentious response, because it is a big departure. Second, I want to summarize a few key areas of the new private fund advisor rule, the PFA rule, that we think are the most important. And third, before handing to Christy for her reflections, I want to outline the GP Trade Group lawsuit against the SEC and CAIA's, our participation in ILPA's Amicus Brief, defending the spirit of the rule. We'll then benefit from Christy's wisdom, which she just hinted at, which I'm really excited about. She has negotiated many LP agreements, side letters, sat in the boiler room of term negotiation countless times. So we're really going to sit under her feet in many ways on that portion. And then finally, as always, joining us for this timely discussion is Jen Choi, the CEO of ILPA, or the Institutional Limited Partner Association, and John Grabel, CIO for LACERA, or the Los Angeles County Employee Retirement Association, which is the largest county capital pool in the country at about $75 billion. So that is where we're going. Buckle up. Let's dive in. So back on episode 2, democratization of alternatives. You might remember we did a long flyover of 90 years of regulatory history, commencing with the 33 and the 40 Act. Now, don't worry, listeners. I'm not going to force you to sit through that again. But if you haven't listened to that episode, it might be helpful in filling in some of the texture to the conversations that I'm going to breeze through very quickly in this episode. So after FDR's New Deal creation of the SEC following the Great Depression, I described in that episode there are two foundational pieces of regulation as close siblings. Their first order of business was the 33 Act, which laid out the requirement and process, with some exceptions, by which securities must be registered with the SEC and have appropriate disclosures and info available. The 40 Act largely defined the blueprint for the requirements and structures of investment organizations, which is why the 40 Act is often called the Investment Company Act. So this sequel act was intended to, quote, mitigate and eliminate conditions which adversely affect the national public interest and interest of investors, end quote. And it was most concerned about ensuring conflicts of interest and other material details about each investment company were properly disclosed. It's really important stuff. So remember that original intent back almost 100 years as we unpack this further. But of course, there were exceptions to the scope and coverage of the 40 Act and this rule too. The oversight and requirements of disclosures did not include a few types of investment companies, most notably 3C1 and 3C7. Now, we walked through the various fund structures in episode 2 in more detail, but for simplicity, 3C1 and 3C7 are just two forms of private funds available only to either high net worth individuals or institutional investors. And they typically include what we now call hedge funds and traditional commingled drawdown funds in venture capital, private equity, private debt, amongst others. And the logic behind what regulatory lawyers call the exempt reporting advisor standard is that the investors or LP in these investment companies, theoretically, could fend for themselves by having appropriate sophistication and financial ability to absorb loss. So these exceptions, as we walk through in detail, were debated and crystallized through decades of judicial interpretation, ad hoc case law, but that moat of autonomy and light touch regulation for private funds was largely understood as the status quo. It was perpetuated and left alone until a little over a decade ago. And following the great financial crisis, Dodd-Frank was passed in 2010. And that's where this story really picks up steam, which was the most sweeping reconstruction of the financial and consumer protection regulatory regime since the creation of the SEC. And after a few years of living in the shadows and even suffering criticism and rollback, Dodd-Frank makes a critical cameo appearance in this new debate. Because in the SEC's press announcement of the new PFA regulation, which is, as all press releases are, mostly self-congratulatory, Gensler cites Dodd-Frank as a key influencer to this new regime. He says, quote, after the 2008 financial crisis, Congress understood the important role that private funds and advisors play. In the Dodd-Frank Act of 2010, Congress effectively required most private fund advisors to register with the SEC. Congress also gave the Commission specific new authorities under the Investment Advisor Act of 1940 to prohibit or restrict advisor sales practices, conflicts, and compensation schemes. This built upon our existing authorities to regulate advisors with respect to their books and records, as well as with respect to fraudulent, deceptive, or manipulative practices, among others. In addition, Congress mandated in 1996 that in our rulemaking, the Commission must consider efficiency, competition, and capital formation, in addition to investor protection and the public interest. Importantly, Gensler finishes, Congress did not cabin either of these provisions, the Dodd-Frank reforms or the 1996 requirements, only to retail investors. Thus, consistent with our mission and congressional mandate, we advance today's rules on behalf of all investors, big or small, institutional or retail, sophisticated or not, end quote. That's a mouthful, but let's cut through some of the jargon and legalese here. Gensler is justifying this new reform on a couple hooks we need to identify. Those emphases were mine, but hopefully you picked up on it, because if you listen closely to these words, you can hear the expectation of litigation, whispering, sitting under the surface through those entire comments. He's already in defense mode. So what are the hooks that he refers to? First, Dodd-Frank, as he says, added a small and obscure addition to the 40 Act. That's Section 211H for you regulatory wonks out there, and that is a term of endearment, I promise you. I have great respect for all the wonks listening. But that broadened authority granted to the SEC in ensuring disclosures, transparency, and fairness was extended to all funds, or more funds, let's say. And to be objective here, a big part of the GP lawsuit is based upon an argument that the current SEC has way overstepped and overplayed the original legislative intent of that small section in Dodd-Frank, which up to this point has not been relied upon at all for new regulation or legislation. So I'll leave that to the aforementioned beloved wonks to debate that, as I'm neither qualified to do so, nor do I find it, frankly, particularly relevant to this whole discussion. But second, and I think much more importantly, the other hook that Gensler cites is this congressional obligation in their agenda to consider efficiency, competition, and capital formation when protecting the public interest and investors. Now, we spent a ton of time in a couple previous episodes on private market capital formation, so I won't belabor the point, but let's be clear. Let's summarize and reiterate a few things here. The large majority of capital formation, of enterprise value creation, you might say, is now happening in the private markets. This is just not controversial or debatable any longer. The number of public companies has halved since 1996. Companies are staying private much longer and increasingly forever. And the large majority of the economy, particularly the new economy, is powered by private companies. Alternative investments is a misnomer because private equity, venture capital, real estate, hedge funds, etc., are now as mainstream as any other asset class. Alternatives on CAIA's numbers represent 15% of the global investable universe at about 22 trillion US. And that can be over 50% of the allocations of some sophisticated endowments. And it's typically in the 20s and 30s of most other institutional investors. And as we covered in episode 2, individual investors are clamoring to get in as well because of the superior risk-reward characteristics of the asset class, diversifying nature of the cash flows, and the performance, etc. So the bottom line to channel CAIA's new brand campaign, next, is here. You just can't put this genie back in the bottle. We are no longer living in a world where the exemptions for private investment companies imagined and written 90 years ago can in good faith be deemed the right guardrails for today's marketplace. Exemptions are for exceptions, and private capital has moved from the exception to the rule. This is not regulatory fiat or overreach, as some are arguing, but it's simply necessary extension of regulations based upon the market evolution. So as we'll cover in depth throughout this episode, this is not to say we agree on everything in this rule, and we don't think the SEC got all of this right. But for the sake of the investor, the investing public, and the greater good, we should at least all be able to agree for all of those reasons that a comprehensive new rule book was long overdue. So let's get into this new regulation with that background behind us. And we'll discuss this, of course, much more with Jen and John when they join as well. And once again, you'll hear me repeat this several times in this episode. We're neither qualified or frankly that interested in covering every element of this rule. And since we're both the hosts, we get to pick and choose. So we're going to tackle the 3 subtopics that we thought were the most important and hotly debated. They also were the 3 that were most frequently promoted and advocated for in the letters submitted to the SEC during the comment period. And depending on how you define investor, anywhere from 20 to 25 LPs wrote letters, and we read them all. And while they were at varying lengths and had different emphases, nearly all of them mentioned these 3 in some form. And those subtopics are cost disclosure, fiduciary duty, and what the SEC called preferential treatment. Now, I will have some opinion woven into this beginning, so forgive me a little bit. But I must admit, the first 2 really perplex me. Cost disclosure, fiduciary duty. If I'm honest, even frustrate me a bit. I think this is righteous anger, but I'm happy to be corrected, as I said. But how can we be debating whether investment professionals owe the highest duty of care and loyalty to a client that is paying them to steward their assets? And why is it controversial in any scenario, any industry, for a paying customer to simply understand and have full disclosure on how these fees are being spent? We're really going to argue about this? At the very minimum, the public quarrel is a very bad look, and it feeds right into the reputational narrative that we're not professionals, but rather rent seekers and robber barons, which is wholly untrue. But we have to realize that this PR play is not landing well. In October of 2019, I wrote an op-ed for Pension and Investment entitled "Prove Private Funds, Don't Do Away with Them." And I've included the link in the show notes. And my argument in the midst, if you remember that period of time of the Democratic primary presidential debates, where the candidates were throwing irresponsible campaign bluster and hatred at the private equity industry, was that responsible reform, not demonization, was the sensible approach, given the growing importance of private capital. But after I defended the importance to the economy and capital markets of private equity, we laid out a 6-point plan to close loopholes and shortcomings of the industry. And the second one was, quote, better disclosures on costs and standards of care, end quote. This is not new, folks. It's been sorely needed for a long time. So I'll put Mr. Obvious aside for a minute. Let's take these in turn, because I also don't want to dismiss that these are significant changes. That is absolutely true. So cost disclosure. The new rule says that GPs must provide LPs with quarterly statements on the fund level that contain detailed accounting of all compensation, fees, and other amounts paid to the GP by the fund, all fees and expenses allocated to or paid by the fund with separate line items related to organizational, accounting, legal, administration, audit, tax. You get the idea. Inventoried by category. In other words, can you please provide a standard inventory of how you're spending the management fee that I'm paying you on a quarterly basis? So to underscore the importance here, I want to provide a little further background from an ILPA study conducted of their members. Remember, Jen is going to join us as the CEO and probably cite and talk about this survey quite a bit. ILPA, by the way, is representative of over 600 limited partners that allocate over $3 trillion to private markets. So very well positioned to have a strong collective opinion on this. And this survey that was conducted in both 2020 and then again in 2022 poses an important question, among many others, is that in your fund negotiations with GPs, where do you spend most of your negotiating capital? In other words, what are the highest priority or must-haves when you think about prioritizing where you're going to die on a hill or press really hard? And the responses are really telling. And in many ways, I might argue, map to the new SEC reform line by line. So first, in 2020, the first time that they took this, I want to give you the top 5. Number 1 was strong key person provision. 44% said that. Number 2, fiduciary duty standard of care. 37% said that. Number 3, no fault removal. 34%. And by the way, I would package these first 3 all in this idea of accountability and putting the client interest first. They're all fiduciary duty facets of the diamond. Number 4 was a seat on the LPAC, the Limited Partner Advisory Committee. 30% said that. And then number 5, there were 3 tied at number 5 in the 19 to 20% range, including this first topic, fee and expense disclosure. Now, as I mentioned, they ran the same survey last year in 2022 in the midst of this SEC comment period for the new PFA rule. And the top 4, strong key person, fiduciary duty, no fault, and seat on the LPAC, all remained in the top 5. Now, just a quick digression here, Christy, because I think your home is a golf home. The Masters, which is hard to argue is the best major of all, they've got this term for the third round at Augusta National, meaning if you're going to put yourself in position to win the green jacket, you need to make a move on the first day of the weekend on Saturday. Do you know what they call that? I just hinted at it.
I don't. My dad's going to be so embarrassed, or he's going to be so upset with me because I should know this as many years as I've watched it.
Christy's dad, forgive your daughter on this one, but it is called moving day. You need to make your move to set yourself up for Sunday on Saturday. Well, shockingly, the biggest move made when ILPA ran this survey a second time last year, you got it, fee and expense disclosure. It exploded from the 19% I just mentioned in 2020 to a dominant number 1 at 51%. That's 22 absolute percentage point increase and a 168% increase in importance. Only 1/4, 25%, of LP respondents feel the reporting provided by GPs across fees, expenses, and performance provides the needed level of transparency. Now, Christy, I want to get your view on this, but just quickly, a few key reasons that were cited as to why the LPs feel this is such a priority and concern is that first, the inconsistency of the reporting now. The LPA rarely lays out, that's the main agreement for the LP. It rarely lays out standard disclosure of costs and fees, and therefore this level of reporting is often negotiated in side letters, which means what one investor gets may not be reflective of what others receive. So as you alluded to earlier, Christy, you need to ask for it. Further, it can be wielded as a negotiating tactic from GPs that comes with other concessions. So in other words, if you want that level of disclosure, I need something back in return. Secondly, particularly on the public plan side, there's increasing scrutiny and vigilance around cost and fee allocation. Boards are mandating more data and information around manager fees. And finally, and perhaps most concerningly, both the SEC and our own experience and conversations globally disproportionately identify confusion, conflation at least, and perhaps even some obfuscation around which fees are charged to the LP. So while the average percent management fee, as we all know, has trended below the conventional 200 basis points, the 2 and 20 framework is largely a vestige of the past. So it has trended down. But the absolute dollar amounts of that management fee are still rising on a net basis, according to LPs, because fund sizes have increased so dramatically. And further, it's been increasingly difficult to legitimize an account for what gets included in the management fee, what gets charged to the partnership, and what should just be organizational expenses of the general partner, things like travel, deal sourcing, regulatory filings, furniture, legal costs. More care, standardization, and transparency on this accounting model is needed.
I think this is actually a great time to jump in because I think that people who invest in these markets and LPs who are pretty well versed have experience with this, but I think the broader public is so attached to that 2 and 20. And by that, we mean the 2% management fee, the 20% incentive fee or carried interest, or what the GP would get from the performance of the fund. But the reality is actually you pay 2 for management fee, you pay 20 for that incentive fee. And then as John, you bring up, there are also fund expenses that do not come out of that management fee. They are charged directly to the fund and the interest of the fund. So things like fund formation documents historically get charged directly to the fund. There are certain deal expenses, for example, just for that fund that then get allocated as an expense to the fund. So it's crazy to me because even as the dollar values have increased, given the size of the funds increasing so much, I was actually going back through and looking at my notes, and I get the sense that one of the reasons why there was such a huge change in the survey responses from ILPA was because that was a point when there was massive demand for privates and people were trying to clamor in, and the terms were moving so far away from LPs and in favor of GPs that I still even remember this starting in 2020, where things that were traditionally considered part of the management fee, like staff salary, like consulting costs, like internal legal, were suddenly being added in the LPA as things that you could charge separately as an expense. I even remember seeing documents that said things like private jet expenses were then charged as fund expenses, not as part of that 2% and not as part of the carried interest of the GP. So a lot of that focus on it was all of a sudden these terms were being added to LPAs that people just could not. Again, let me back up and say, anytime you're doing due diligence, go to your LPA and at the very least, do a Control F and search for fees, because you will come up on a page that outlines the few things that they'll put in the management fee and then the 5 pages worth of additional expenses. At least that's how it was in 2020 as things were changing. So I think a lot of it, again, was because there was this shift in the traditional way that this had worked versus all of a sudden all these additional expenses that were getting charged on top of the fund. So it looked like the management fees were dropping just in the percentage terms. But to your point, the funds were getting bigger and they were then charging things like, again, salaries, things like rent for your office space. That's when about 20% of GPs, even as of 2022, charged rent as an expense to the fund and not as part of the management of the GP. So yeah, I think that there is, again, this element of how it works in theory versus how it works in practice that I think a lot of people just started to feel like it was very unfair. So I think that that's an important context. And I will add, though, that even with all of that said, one of the cool features about private markets is the ability to customize your transactions, the ability to negotiate your LPA, the ability to read it and decide affirmatively or with your feet that you're not going to engage in these terms. And I'm not sure that just regulating what bucket things go into or what can go into each individual bucket necessarily works for the industry as a whole. So again, while I wholeheartedly agree with the need for transparency, having sat on the other side and thought, this is insane, I also get that each fund is individual and they invest on behalf of unique organizations. So I don't know. I think that just standardizing across the board is also a dangerous false sense of security almost.
No, I'd agree. And I know I speak for Christy when I say this. The very large majority, very high percentage of GPs are not doing this in a malicious, secretive way, trying to pull one over, play the shell game. Absolutely not. All we're saying, and I think Christy makes the right point, the SEC is not giving rules or box checks on what can be included and what can't. That's up to the LPs and the GPs. All they're asking for is full disclosure. So I don't understand, as I said at the beginning, why that's provocative. Uniform and consistent minimum cost reporting standards, I think, and I'm sure I'll be claimed as naive on this, but I think that would be good for everyone. In my mind, actually decrease administrative effort and labor versus the bespoke, ad hoc, and selective LP by LP reporting dance that seems to happen today. So let's move on. Fiduciary duty. This was a bit of a nothing burger and disappointment in my view. So the original proposed rule is not being adopted in any form in the final version. So basically, no change. Keep on keeping on. As I mentioned, this was listed as the number 2 most important topic on the ILPA survey and was the only other answer outside of the massive rise of cost disclosures that we just talked about that increased materially from 2020 to 2022. It went from 37% in 2020 to the clear number 2 at 43% in 2022, a 20% increase in importance. So what was the issue here? Well, LPs have grown considerably worried with the erosion in standard of care to the client, with about half the respondents claiming that fiduciary duties have been contractually modified or eliminated, certainly diluted in the funds they've invested in. This usually takes the form of a more widespread use of what's called sole discretion language and expansive indemnification provisions in both the LPA and in the side letters. Now, to be clear, LPs have largely acknowledged and advocated to the SEC in all those letters I mentioned that raising this standard to ordinary negligence would perhaps create unintended consequences, where GPs would suffer so much litigation paralysis that risk-taking and eventually investment outcomes would be negatively impacted. However, gross negligence clauses would largely hold the GP to the same fiduciary duty as the LP is held to by its beneficiaries and would have been a great step forward for the industry. This is what the message of most of those letters that I mentioned earlier claimed. And once again, I'll add, it would make administrative and negotiating burden so much lighter if this minimum standard language was included in the LPA and taken off the agenda, the long agenda, as we'll get to, for side letter conversations. So that's fiduciary duty, a bit of a swing and a miss there. We'll have to revisit that in the next chapter of the SEC regulation. Okay, then thirdly and finally, the real lightning rod from the original proposed rule that had both the GP trade groups and the LPs largely in sync in their concern about the overreach is what the SEC called preferential treatment. The SEC seemed most concerned about a few areas of unfair or, as I said, preferential treatment, specifically around fees, the economics of the deal, redemption rights, and portfolio holdings. Like the fiduciary standard, there was considerable softening of the rule in the final edition versus the proposed edition. But in this case, we actually think the rollback was warranted and perhaps not even far enough. So the original rule had a fairly dogmatic prohibition under most circumstances around any type of inconsistency in fees, redemption rights, and portfolio holdings. And the new rule basically moves to a disclosure framework. In other words, each LP needs clarity on the material economic terms, exceptions, and range of agreements given to their fellow co-investors, is what the SEC argued. And we'll come back to that phrase, material economic terms, in a few minutes, because I think it does perhaps create some confusion. But LPs in particular had 2 main criticisms of the original prohibition of any range of outcomes in LP negotiations. First is Basic Economics 101. LPs that write a larger check or take a chance on a new manager with a seed investment should be compensated with more attractive economics. And look, we all get this. The SEC, understandably, was particularly concerned about small or first-time LPs getting gouged on pricing if they weren't an anchor or large repeat investor. But every small LP I've ever talked to completely understands that a $500 million check probably should justify better terms than a $5 million check. This is not damaging to the smaller investor, but it's accepted market practice of differentiated treatment in any domain of business, not just investing. So, for example, Christy, I guarantee when Hertz bought thousands of Kia EV6s, the ones that I always pick when I rent from Hertz, that they got a better per unit cost than I would have if I go to my Salt Lake City Kia dealer. I'm not bitter about that. That's normal and expected. They bought a ton. This is economies of scale. This is capitalism. So given the overwhelming response from LPs and GPs, the SEC said, okay, fine. But you need to disclose to everyone else before they invest any materially economic term differences. And frankly, Christy, at least in my research, all this is doing is memorializing what is often called the most favored nation document across all LPs. The MFN, in a very simplistic terms, is an appendage document to the LPA that lays out and defends the special terms afforded to the largest investors. So the process, while currently complex and a bit of a beauty contest, already has a foundation, although it may be duplicative with the MFN. So we'll seek Jen's view on just that. In any case, the new rule simply broadens that and requires all LPs to have a full explanation of those tiers of obligations and promises. So the other facet of investors' original concern was the implication to side letters. Now, we've noted side letters several times already. So for those of you unfamiliar with the junk drawer organization of LP-GP agreements, what they basically operate like vendor agreements you might have signed for IT software, hardware, or consulting work that has, on the one hand, a master service agreement, an MSA, and then several underlying statements of work, or SOWs. So the master service agreement, if you've ever bought technology or bought software, it lays out all the generic information of the contract, the two parties, their legal domicile, indemnification, general expectations, term break, things like that. And then if you've negotiated and signed these types of arrangements, they typically also combine one or more subordinate SOWs. And that's where the rubber hits the road. So the specific term, economic arrangements, explicit joint responsibilities, and deadlines, for example, are all laid out in those SOWs. And that's admittedly a very imperfect way, but perhaps helpful way to think about this. The LPA is the MSA, and the side letters lay out the LP's specific needs, expectations, and terms. And side letters are very important to the LPs for things like specific economic arrangements, ESG and DEI standards, investment restrictions, fiduciary standard key person provisions, as we just talked about, customized reporting demands, confidentiality. John Grabel's letter to the SEC said something really interesting, said that side letters are the most powerful tool at the LP's disposal to advance market practices and innovation. And specifically for government entities like public pension plans, LACERA included, they are a required box-checking exercise to ensure state-level fiduciary and legal terms consistent with their statutory responsibility are met. So over 3/4, for example, of responding LPs to the ILPA survey we've been quoting claim they would not be able to invest in PE if not for these customized side letters. So the original rule and its attempt to whitewash all LP-GP terms was viewed to have been a major impediment to continuing to exercise side letters for very important purposes. So coming back to where I begun this preferential treatment discussion, the disclosure obligation is all based on this ambiguous and subject to interpretation phrase, materially economic terms that would have a negative effect on other LPs if they weren't aware. So that's still a major question. What in the world does that mean? And what are the conditions that determine damage to other LPs? I have to imagine the eye test on that is going to differ substantially among GPs and LPs. And case law and all kinds of judicial interpretation is ultimately going to get dirty and nasty with this. But this confusion and variability and ultimately further complexity is one unintended consequence that I think the SEC perhaps underestimated. And we'll spend some time, as I've mentioned, with Jen Choi on this trade-off in a few minutes. So before handing to Christy, I want to finish with a brief description, as I promised, of CAIA's recent decision to sign the ILPA-sponsored Amicus Brief that we submitted to the Fifth Circuit Court. So some quick context here. The Fifth Circuit Appeals Court is the domain of the suit from the conglomerate of 6 alternative trade associations. That's AIMA, the MFA, the National VC Association, American Investment Council, the Loan Syndications and Trading Association, asking the court to set aside the final PFA rule on the grounds, as the suit says, that they exceeded the SEC's statutory authority and are arbitrary, capricious, and otherwise unlawful. So what's an amicus brief, you might ask? I had to ask the same thing when we were first approached. Well, it is a document submitted to the court offering advice, information, and a different perspective from an organization not directly involved in the suit. So as I mentioned, ILPA originally sponsored and facilitated, led the process with CII, the Council of Institutional Investors, and CAIA, us signing up as additional partners. And additionally, 11 asset owners or institutional investors have also signed the brief, most notably CalSTRS, Washington State Investment Board, State Board of Administration of Florida, some big, big players. And interestingly, by the way, these pension capital pools were not on the list I alluded to earlier of about the 25 that already had submitted letters. So these are 11 incremental ones. So why do we all decide to do this? Well, just as I hope the tenor of this episode has conveyed, we are not pretending, we've said it a number of times, to agree with every piece of this rule. We've been very open that some portions were right on, some stopped short, some represented some naive overreach that will eventually perhaps have to be rolled back. As such, we do not focus in this amicus brief on a point-by-point defense of PFA or a point-by-point response to the GP lawsuit. Rather, what our collective voice is attempting to punctuate is the support of the spirit of the rule and its contents. Over the last decade, as alternative investments and private funds have proliferated, LPs feel that the balance of power, and you mentioned this, Christy, and a disproportional benefit have shifted to the GP. This has been caused by a number of things, such as the power law, which generally referred to as this idea that outsized performance and the most attractive alpha are increasingly concentrated in a narrow set of managers. So the power law, consolidation of the pool of GP's external legal counsel, information asymmetry, challenging switching costs due to the long tail of due diligence by LPs, and fear of losing allocation of the next fundraise. This is not anyone's fault necessarily. It's just the reality of the evolution of this industry. In fact, 73% of LP respondents to that same ILPA survey said that the overall movement of the LPA terms have heavily shifted in favor of the GP in the last few years. So we believe, to conclude here, that this rule, while imperfect, plays an important role in simply trying to level the playing field in a much more mature alternative investment ecosystem we currently find ourselves in. And we thought that the public debate needed another perspective, a more data-driven and perhaps objective perspective. Now, most of the listeners will know the epic mysticism of Howard Marks's famous client memos. We probably all have our little anecdote from one of those memos. Christy's pointing back to her notebooks of Howard Mark memos.
I was going to say, I have the 2-set book of his memos. It's great.
There you go. So I want to finish by quoting Howard on one that I hadn't read before in March of 2011. So this is a bit dated, shortly after Dodd-Frank. He wrote one of those iconic additions to his canon, outlining the dueling forces of free markets and regulation, and our tendency to swing the pendulum too far in each direction as cycles come and as cycles go. And Marx claims that two conflicting truths exist. Number one, the financial system can't be entrusted to untrammeled free markets. And two, the responsibility of the financial system can't be delegated to regulators. They are both imperfect solutions on their own. So where does that leave us? They must awkwardly and clumsily coexist. Because left unchecked, the free market capitalist system runs on self-interest and desire for profit. It tends to get over its skis a bit, and we need regulation once in a while to ensure these things are kept within reasonable limits. So channeling Marx, that's all we're saying here. GPs have the right to prosper, absolutely, if they are delivering on their mandate and investment outcomes. We are huge believers in that, and we want to fan the flame of successful investment professionals and their firms. The most important heuristic, however, that we cannot forget on this is that LPs are the client. It's their money, it's their fiduciary responsibility. So a fair, efficient, and transparent marketplace that serves the principle is our ultimate goal. So I will end there with my diatribe, Christy, and hand to you. You have sat in the hot seat, so educate us.
It's so tough because I'm really glad that you included the thoughts of Howard Marks, because I think that there's such a great way to frame the issue in the sense that as the industry becomes larger, and I believe it's 20% of all industry right now is somehow owned or operated by private equity or venture capital. And that's crazy just from where it was. So as professionalization is required and continues to be required, regulation is going to come with that. With that said, I did not see anywhere in the background that Gary Gensler or people right beneath him have ever worked on the LP side or frankly, even the GP side, because I believe he was an iBanker at Goldman before he devoted his life to public service. So again, I think that a lot of times, while I think it's great that they listen to wonderful organizations like ILPA or like CAIA, and even trade organizations that speak on behalf of others in the industry, I think it's important that particularly as the industry wants capital from retail, that with that is required a level of disclosure and professionalization and transparency that many probably aren't used to. With that said, it's funny because one of the big things that we haven't talked about is that the SEC in this rule is demanding that audited financials are provided to LPs. And when you look at the data in the document that they submitted, the rule document, the 600-page one, they actually have charts, and over 90% of hedge funds and private equity funds already provide audited financials that meet all of the requirements of regulatory agencies. So again, it's this strange disconnect where there's complaints about it, but I think that the vast majority of what's being requested in the rule itself, is it going to improve efficiency the way Gensler and others claim? I don't think so. It will in terms of transparency, but I don't think that that efficiency is going to create more competition amongst funds, because that's the assumption, what they've done on the mutual fund side, that it's driven by fees, when in reality, it should be driven by due diligence process and investment decisions. Revisiting the fee side, it's interesting to me too, because I already went over the 2% plus the 20% plus the expenses. If you look at that though, it's interesting to me how they're going to standardize the template, because I looked at ILPA, for example, and I appreciated that they actually have all of the additional fees that get tacked on, like broken deal fees over some of the others, transaction fees, advisory fees. Most GPs don't charge monitoring fees to their underlying companies anymore for a number of reasons, but some still do. So that's a different thing, and that's offset. So you get a much better picture of not just the fees, but the offsets to those fees. Because to your point about the need for transparency, one of the things that was really shocking to me is that if you look at, for example, broken deal fees, which are basically a bucket of fees on the GP's expenses that get charged to the fund, and it's anytime a deal breaks up. So all of the travel, underlying due diligence, all of the stuff associated with that. And I found a private advisor CFO survey of hundreds of GPs. And basically, if you look at that, 65% of the survey respondents said that they charge those broken deal fees to the fund. But sometimes you also get proceeds back from those broken deal fees. So the company has to pay a breakup fee. You get the money back in your pocket. Only 35% of those surveyed actually credit those proceeds to the fund. So you start to get this picture of, I don't think that anybody is doing this with a nefarious intent. It's just that is what's market, and that is what's standard, and that is what they can legally do. So I think that we do have to also, not to get pedantic, but we do have to look at what is how we report the fees in the bucket, and what is an industry standard for how those fees are appropriately dealt with. And I put a lot of the blame on the LPs for not having a more standardized demand for that. I think that one of the areas that this also does really great, and I can't remember if we touched on this, but this new rule actually disallows GPs from charging SEC enforcement and regulatory action against the funds to the LPs. So that used to be a thing that many funds could do. It was in their legal documents. A lot of times they would split it, or the GP would take on the cost, especially if they were at fault for it. But the legal documents did allow them to charge it to the fund. So LPs would have no understanding or no view on if the valuation was meeting the SEC's requirements, and yet they would still get charged the fees associated with enforcement of that. So again, I appreciate the willingness to shine a light on it. And I think it's a good first step in terms of how we are going to navigate what should ultimately be a partnership. The fiduciary one, it always bothered me. I will say, if there was one thing that gave me PTSD in this, it was thinking back to the fiduciary, and just watching that get struck from documents was so frustrating, because it goes from the GP is required to legally consider the needs of the LP and to put them ahead. And that's not the case. And there's lots of weird ways that that plays out. And I think that a lot of times, a lot of LPs just recognize that you have to fall back on the partnership and the relationship and really invest with people that you trust. Because even if it's not in the document, that doesn't mean that they aren't bound by it in some personal sense. Because there were plenty of GPs where their legal advisor was basically telling them, hey, you need to take this out for a number of reasons, whether that be for insurance or whatever else. And ultimately, they still would do right by the LP. So I'm with you. I don't think that this does enough in terms of the legal side, but I think it, again, reiterates the importance of the relationship and the fact that the GP and the LP are in a partnership together. And literally, it's limited partner and general partner. We have both conflicting interests, but also symbiotic ones. And ultimately, I think that there is a happy medium that doesn't necessarily have to take it's in the legal documents, but that does address the need to put your constituents ahead of your own personal needs. I will say, in closing, the preferred treatment, that one was a weird one that the SEC pounded the table on. It's funny because even when LPs do side letters, I know for a lot of pensions, it's we have to sue you in the state of our origin and not through Delaware, because that's a legal requirement from our legislature. As an LP, I don't care about that. It's going to suck if they get sued, but the odds of the lawsuit are pretty slim. And ultimately, the law is what it is. So I'm not going to begrudge a $500 million pension in California from saying, hey, our lawsuits have to be in California. I'm also, if they're the founding shareholder and the foundational investor, I'm not going to begrudge them having better terms, especially if I come in on third close and they were there day one. So again, I thought that was a funny one that they got hung up on. And I was glad that it sounds like the SEC really worked with ILPA. And honestly, ultimately, in my experience, it was just about requesting the MFN right anyways. And would you get it? I don't know, but you can always ask. And I will say in closing, building on that thought, I am curious as to what the externalities of this are going to be, because Dodd-Frank had them. Sarbanes-Oxley had them. Frankly, part of the reason why there's so much money going into private funds is because a lot of companies don't want to deal with the regulatory side. So I'll be curious how this filters through. And I just want to remind LPs in all of this, yeah, you have a target to privates, but if the terms are still moving away from you, which they're not so much anymore, but if you can't feel comfortable with the terms, don't bucket fill. And I know a lot of you aren't, but you have agency. Read your documents. You have the ability to either request changes or to walk away. And it's so surprising to me that people are just like, oh, well, this is unfair. We're being mistreated. But the reality is, okay, well, then don't put your capital there. If you don't feel it's a good partnership, work with the organization to find your lines in the sand and then find GPs that will happily work with you on that. And I know sometimes that you won't end up in the brand name or the one that you wanted, but there are great GPs out there that are outside of that. I think according to the SEC documentation, there's over 12,000 funds. You can find GPs that are your people. And if they're not your people, that doesn't make them bad. It's just that, again, going with what I said before, there are some things you can live with and there are some things you can't. Ultimately, I think regulatory is a step in the right direction, but I don't think that it absolves the need to have that partnership and to have that strong due diligence and to really understand where your red lines are, both on the GP side and the LP side.
That was helpful. You said a couple of very important things that I just want to underscore, which is the story of regulation is written many years, sometimes decades after the reality. So the externalities, the unintended consequences are all unclear. And if any of us are pretending to be able to precisely identify those unintended consequences, we're fooling ourselves. The other thing is that, look, Gensler, one interpretation, I think this is fair. He listened and rolled back some of these. I think that's a very fair and worthy of recognition type of interpretation of what happened. Let's also be honest, though, when we think of fiduciary duty, it's a signal of what's coming. I don't think we've heard the last of that. So while it has been rolled back, and that was a case where I thought maybe unfortunately too much, I think part of these proposed rule is to signal and give you a sense as to where we're going. This is still top of mind, so we'll see what happens. With that, we're going to have to close and move to John and Jen. I am so excited to hear more about everything we've just said from the experts that have been in the trenches on this. But before we do that, as always, we're going to move to our discussion with Franklin Templeton Alternatives. Well, as promised, we are here with Dave Donahue. Dave is the co-head of U.S. Wealth Management for Franklin Templeton Alternatives. Dave, welcome to Capital Decanted.
Thank you, John. Great to be here. And thanks for you and CAIA for everything you're doing for the alternative industry. Truly appreciated.
Well, we are grateful for your participation. Franklin Templeton Alternatives is the title sponsor for this season of Capital Decanted. And we are grateful for Franklin Templeton's long-standing devotion to client-first mentality, to ensuring that clients build diversified portfolios. So this was a really great match and partnership for our first season. Dave, maybe a couple of questions for you, because I think a lot of listeners might be unfamiliar with the sheer scale and scope and activity, M&A activity of Franklin Templeton over the last several years. Tell us a little bit about, just level set for us, the alternatives offerings and scale at Franklin Templeton.
Absolutely, John. So alternatives are just a natural extension of what you described earlier as a client-first mentality. For 75 plus years, we've been focused on helping clients solve problems in the investment landscape. This is a part of that. But you're right, a lot of folks aren't aware of our size and scale today. Alternatives by Franklin Templeton is now approximately $260 billion in assets, making us a top 10 player in alternatives globally. And we cover all the major food groups, from private real estate, private credit, private equity, and hedge funds. I think we do it in a unique way, focusing on acquiring best-in-class and differentiated institutional alternative managers, leaving them 100% alone from an investment perspective, and then bundling the resources of Franklin Templeton around them to help bring their business to the private wealth space. We're really excited about that.
Fantastic. And maybe as we think about Franklin Templeton's history, I think most people would come to mind would be a very reputable and a longstanding history around public equity, mutual funds, international investing, particularly the Templeton portion of the brand. When was this moment of realization that you needed to diversify, and how has the organization gone about building out this stable of offerings you've referred to?
Yeah, it's a great question, John. I go back to our CEO, Jenny Johnson, who I know you know well. And Jenny's always thought long-term about this business. Franklin Templeton, if we flash back in time, invented the mutual fund in many ways, shape, and form to help democratize access to public markets for individuals. And we're doing that here. So about 5 years ago, we took an approach that said traditional investments will be a key part of our business going forward, period. But there's this growing landscape of alternatives where technology, operations, and regulatory structure are making them more accessible for the individual. And we want to participate in that. So while a lot of traditional firms have dipped their toe into the pool of alternatives, we've really tried to take a cannonball into the deep end. We've done 4 key acquisitions over the last 5 years that have scaled our business to the $260 billion we're at today. And what's really important to us, John, is 3 things. One, I mentioned this earlier, best-in-class and differentiated institutional alternative asset managers. Every firm that we own in the space source 98+% of their capital from the largest institutions globally. We don't want to change that. What we want to do is maintaining their investment integrity, find ways to package and bring those products to the wealth space. And we've dove in the deep end there by building a 40-person end-to-end distribution team in the US focused on private markets and hedge funds to complement the work we do on the traditional side as a trusted brand to advisors. And the benefit we're seeing in conjunction in partnerships with firms like CAIA is really that trusted voice that we've built over decades is allowing us to help educate the next set of advisors to adopt alternatives on how to do so responsibly and appropriately for their client portfolios.
Outstanding. And I think listeners, you hear that devotion to client first threaded through all of Dave's answers, which we really appreciate. Dave, obviously, you don't want to give away trade secrets or maybe bring out the crystal ball, but as you mentioned, several food groups that you guys have been active in, building out, as I said earlier, this stable of offerings. Are there gaps or particular aspirations that you think we might expect to see, whether build versus buy, Franklin Templeton continue to grow their business in?
So if I think about gaps first, our gaps are in the real assets and the infrastructure space. We have a great real estate business through Clarion Partners, but we don't do real assets or infrastructure today. The other big notable gap is on the private equity side, where we do growth and venture, where we do secondaries through Lexington Partners, but we don't have an LBO buyout business. I'd say our aspirations between those 2 gaps really do lie with the infrastructure space, and our CEO, Jenny, has been public about that. You have to do it with the right firm at the right price and the right time, but infrastructure is a future focus for us. And I would tell you, John, our overarching focus today is on execution. We've acquired the right managers. We've left them in place to do what they do best, which is manage capital. We've built our team, and now we're laser focused on being the right partner and friend to the distribution teams we've worked with for decades on the traditional side.
Outstanding, Dave. Well, really good flyover of what you guys are doing. And it is very dynamic. There is kinetic energy to what you're building. The enthusiasm really just comes through each time I talk to a portion of your organization. So on behalf of the entire CAIA community and all of our listeners, thank you again for your support and partnership for this podcast. And listeners, stay tuned. We're going to move on to our segment where we invite our guests in. Thanks again. Welcome back to Capital Decanted. As promised, we are thrilled to be joined in studio by Jen Choi, who is the CEO of ILPA, the Institutional Limited Partner Association, and John Grabel, the CIO of Lacera. Welcome, and thank you for joining.
Thanks for having us.
Well, it was an interesting preamble that Christy and I talked through, and we are taping this, Jen, completely coincidentally on the day that ILPA has released the press release regarding our Amicus Brief that we have signed on with you amongst many other asset owners. And so we'll get to that in a moment, but serendipity sometimes does exist. So we're looking forward to continuing to work with you on behalf of investors. So I want to start perhaps leaving the PFA debate aside for just a few moments and maybe do a little bit of retrospective and table setting with both of you here. How has ILPA thought about the state of private markets? Let's go back to Dodd-Frank post-GFC, the last 10 to 12 years. because there's just been an explosion in all forms of the word, evolution in all facets in this industry. What has ILPA's areas of focus been as you've been advocating and building relationships in Washington, Brussels, and across the world?
Speaking of serendipity, it so happens that the entirety of the span of time that Dodd-Frank's been in effect for private funds has been my tenure at ILPA. So one of the very first things I had the pleasure of working on, it was right after the Sunshine Speech in May of 2014 when I joined. So thus began a journey of engagement with SEC staff, with the chairs, multiple chairs over that period of time, education about the needs of LPs, how the industry works, but always with some very consistent messages. One, of course, being the need for standardized disclosures, the importance of transparency to limited partners. That's been a key feature of our advocacy, of our engagement on policy in the US and in Europe. But we've also elevated with regulators, both in the US and in Europe, the importance of standard of care and fiduciary duty and fiduciary obligations. And we've been trying over the last decade to really help policymakers and regulators understand how those duties have eroded and why they are so critical, just given the long-term and illiquid nature of these products and the long-term nature of the partnership between LPs and GPs. So those are two key facets of what we've been very focused on over that span of time. And of course, we've also just tried to, at every opportunity, underscore the importance of a floor, a minimum standard that really does benefit the industry as a whole. It's good for LPs, it's good for GPs. It means that they have to navigate fewer requests for information, fewer formats, and that the expectations are level set at the outset of establishing these relationships and over the course of decades in the case of some of these relationships. So those are just a few things that we've been very consistently pressing for, John.
John, can I add a couple thoughts?
Absolutely.
Which is, first, it's great to be here. And at Lacera, we applaud the effort of ILPA in terms of pushing for those standards. It's important to us. It's important to our members. And maybe one aspect of it is why it's so important is the growth of private assets, the increasing allocation in institutional portfolios, where in the 80s and 90s, it was a small allocation, and it's grown to be maybe not a majority of assets like it may be for some endowments or foundations, but for many institutions, I know for Lacera, our allocation to liquid investments is over 40%, which means that all aspects of governing those assets, valuing those assets, and the relevance for our financial statements, for our members, for how we calculate contributions, how we manage risks is that much more important. So everything that Jen said is increasing in importance. And much of this is occurring at a time. It's not a surprise that allocations have increased because during the era of Dodd-Frank, since the GFC, interest rates up until recently have been trending down, which means cost of capital has gone down, which has incented people to move into alternative asset categories, into private assets. And once again, maybe this is a continuous loop or a thread that we pull as to why it's important what ILPA has been doing.
Well, and John, building on that, just that increase in relevance point that you just made, how's your process changed and evolved in that period since Dodd-Frank, and particularly your due diligence with ODD and legal and these different factions and parts of it? And has that changed the conversations that you're having with GPs as well?
I think it's changed in a variety of ways. I would say one is our diligence investigation is becoming increasingly complex. And I would say that every time we underwrite a fund, every time we monitor an existing relationship, it's not more complex, but there are more components to it. And 25, 30 years ago, when we were underwriting a private equity firm, for example, we may not have done cyber diligence. Today, that's just standard. Part of our diligence is to look at their systems and how they safeguard assets, what their trading platforms are, what the comprehensive nature of their accounting. So I would say that our diligence is more complex and increasingly has more modules. I would say it has also moved from this traditional two-dimensional world of looking at expected returns and risk solely being volatility. we look at ESG considerations, for example. And we do that because we believe that environmental, social, and governance factors are relevant for value creation. And that varies by industry, varies by sector, varies by opportunity, but that is a way to increase and enhance value for our members. We also look at the importance of talent management. That is a firm putting the best team on the table. And that's another aspect of our underwriting that we've really enhanced over the last 15 years or so. And I'd say one other aspect is we're much more mindful of illiquidity and the risks associated with it, which means that we want to make sure that our portfolio is as intentional, or we can increase the intentionality of it, so that we really want to understand sectors, exposures, stages, geographies, such that we want to understand where our investments are. To the extent we can have an exposure, we believe that that exposure, we should pay the least amount possible for it.
I think that's really helpful retrospective from both of you. I mean, one of the things we said in our introduction segment was really the arrival of illiquid or private assets in allocations, as John said, in top of mind attraction in all forms of the word, is really why we're even talking about this. So in some sense, this is a reflection of the maturity and the fact that this has grown up, and it needs more attention and guardrails and rules, if you want to call it that. So I think that's the context we have to keep in mind, that the attention and the discussion and even the debate at times that gets uncomfortable is all because this is a really critical part of our asset allocation structure in which we all should take credit and pride in. So, Jen, let's maybe move on to the latest chapter of the story. As I alluded to at the beginning, this new private fund advisor rule, which is certainly not the last chapter, but a big culmination of much of your work since you joined ILPA, both in your advocacy role and now sitting in the CEO seat. And I do want to break down a few of the key areas in a few minutes. But before we do that, one of the words that I've been thinking through as far as my general response to the debate has been a little bit disheartening, to be honest. And that is that I've been surprised and a little bit discouraged about why on balance LPs have largely supported it. I mentioned that I read all 23, 24 LP comment letters, including ILPA's. There was some very direct and strong language on, quote, the other side from the GP suit. And that just gives me pause. Have we really advanced that far in GP LP alignment that I think we all work so hard for? How far along in this professionalism journey are we? So maybe that's something to reflect on. But more specifically, CAIA has signed on with you to this Amicus Brief, as I mentioned, and it certainly does not, as ILPA has said, as CAIA has said publicly many times, suggest that the rule is perfect. We think they nailed some, were weak on some, and perhaps overreached on others. But with all that background, Jen, maybe you can describe a little bit of your motivation in your discussions with your members, I assume, and your own discussions with the SEC. Why did you feel this amicus was important, that this voice to add to the conversation was critical? And where do you think this goes from here?
Just to start by responding to the disheartening emotion that you called out, John, I think it's important to level set a little bit the reality of what's going on in the nature of the debate that's taking place in the public square. You have to look through to which voices are actually represented. And if you look through those comment letters, you see a lot of individual ILPA members, LPs, institutional LPs, John's included, that have put forward commentary as part of the comment process that kicked off last year. On the part of the GPs, you see a lot fewer of those representations of full agency on behalf of an organization, and you see a lot more of advocacy as filtered through organizations like ILPA or CAIA or others. So it's being fed through an industry voice. And what are the implications of that? I think one of the implications of that is anything that's coming through an industry body like us or like any of our aligned or similarly situated organizations in the industry is that you have the ability to say things that maybe an individual organization couldn't. And I think that really manifests in the tone of some of the arguments that are coming forward on the part of some of the GP reactions to all of this. But I do think that it's fair to say that some of it feels hyperbolic because we certainly talk to LPs and GPs every single day. And I think a lot of the doom loop type of characterizations that we've seen over the last almost 2 years now since the rule was first proposed speak to near-apocalyptic worst case scenarios that on closer inspection and in dialogue with individual LP and GP organizations doesn't hold up. So I would just call out that I wouldn't take the signals and the cues from the most publicly facing or publicly visible aspects of all of this as the signal of the core truths of the relationship between LPs and GPs. I think the striving towards partnership is absolutely still there. And that's what gets us up out of bed metaphorically every day, is to make sure we're doing our part to make that partnership as strong as possible through guidance or advocacy or other means. As to the motivations for why did we do this, it's consistency. We've been engaged on these issues. We've been engaged with the SEC since day one, well before day one of the release of these proposals. And so to not follow through at this important juncture when you've got litigation pending, when you've got potential outcomes from this case that might result in a serious diminution of the SEC's role as a singular body that has oversight of private funds in the US at least, to not engage just seems anathema to us. It's just completely inconsistent with everything that we've done to this point. So we thought it was important not to do a point-by-point tit for tat for what the GPs have, the GP groups, I should say, and the petitioners in their briefings, but rather to make sure that certain points are being pulled forward, whether those are things that are in the SEC's response or things that maybe haven't gotten as much attention, such as who are LPs, who do they serve, what does sophistication really mean? Does sophistication really overcome some of the structural challenges to the industry? So we certainly don't want to see that oversight role of the SEC stripped away as a result of this litigation. That's one of the primary motivations for engaging at this point. But also we wanted to make sure we went on the record as to the importance of the PFA rule and SEC regulation.
Well, first of all, Jen, thank you for the therapy session. My disheartening attitude has changed to pensive. Let's put it that way. So I need to call you more often when I have bad days. So John, maybe shifting, what about from your perspective? Jen just mentioned that you wrote one of those 23, 24 LP letters. I read that. You talked about, based on the question from Christy, your ODD and due diligence complexity proliferation, that this has gone, not to put words in your mouth, from a linear process to a mosaic with a lot more moving parts and modules, I think was your word. Why is, particularly for a public pension plan like yourselves, but I assume this would apply to most asset owners, why is transparency, disclosure, fiduciary duty, maybe most important, so important to you and your team? And why is it maybe heightened in recent years?
Transparency is a core tenet of managing money, investing money on behalf of a public organization. That's almost like a period full stop statement, in that we have the privilege of managing the retirement benefits for over 190,000 members, employees across Los Angeles County. And that is a tremendous privilege. And going back to the conversation, John, that you and Jen were having about maybe being disheartened or the pensivity, I think that every person across that ecosystem, be it LP, GP, trade organization, or otherwise, needs to recognize that this privilege, the fact that all of us are representing other people, and that we have to have the humility that comes with that, recognizing that we're part of an ecosystem, that we're part of a larger collective. As it relates to the importance of transparency, it is important for us, as our return threshold is 7%, as we model portfolios and try to portion assets across different asset categories, we need to understand what is in that portfolio to best position it to earn that 7% through a variety of economic environments. And we've seen, even over the last 3-4 years, it's almost been multiple economic cycles in a very compressed time. And I think that having that transparency has aided us in terms of positioning the portfolio and navigating a very trying environment. We do that recognizing that Lacera is cash flow negative, that our benefit payments exceed employer and employee contributions, which means that we have less of a margin of error. So that increases the need for transparency. And part of it is also what I mentioned to Christy, is that to the extent, and maybe these are some examples, to the extent we don't have transparency, what we think we're investing in may not be what we're investing in. If we allocate to a technology fund and they are investing in energy, well, energy resides elsewhere in the portfolio. We have experts that are adept at underwriting energy investments. And is it the right risk return framework to have a technology fund, for example, in investing in energy? Or another example may be to the extent a private fund is holding on to public positions and we're paying a high management fee and carried interest on that, well, that's not something that's necessarily helpful. We're overpaying potentially for that exposure that we can get for a lot less. So by transparency, we're able to ascertain that. Some other aspects of why it's important is the avoidance of conflicts of interest, of related party transactions. I think that is absolutely critical for GPs to recognize that there's oversight of them. That's part of our duty to our members, is to make sure that we are responsible stewards of capital. So I think that the ability to have portfolio transparency really aids in that oversight. And one other aspect relates to, we invest and are subject to various regulatory environments. In California, for example, there is maybe it's leading in terms of fee disclosure and transparency. We need to abide by the law, but we go one step above. So we disclose more than we have to. So I think that part of this really goes back to recognizing whose money it is and that we're a public agency.
I appreciated that. And I completely agree with you on the transparency side. But Jen, I want to switch gears real fast and jump into more of the terms of the rule and where LP stand. As John has mentioned, ILPA and basically all of the letters to the SEC that we reviewed, so the 24 to 25, made it clear that you didn't think that the rule was perfect. So particularly, investors felt that the preferential treatment disclosure requirements in the areas of fees and redemption rights and portfolio holdings was an overreach. Can you summarize where you and your members come down on this particularly important element and what the final rule may mean? Will the disclosure rules hurt investors' ability to negotiate optimal terms, or will the transparency actually help?
So I think it's helpful to just underscore that of all of the things that were in the initial proposal and in the final rule, this preferential treatment set of rules specifically were the source of the greatest concern for our members, full stop, for various reasons. So I think as we evaluated what is the likely impact of the final rule going to be, that is naturally an area of close scrutiny and observation from us and from our members. For your audience's benefit, they may not be aware that the SEC, in normal order of business, would be open to dialogue with us, with industry groups, with individual constituents such as John, about how should we interpret this rule as we negotiate for new funds, as we craft new documentation. Given pending litigation, staff is unable to engage in that dialogue. So we are operating in an unfortunate information vacuum, despite the fact that because there was no stay, no injunction, the rule as approved in August of last year holds, and the implementation timeline holds, of September 2024. By my clock, that's a little over 8 months away. And we don't have the clarity on how some of these things would be implemented under SEC examination requirements and potential enforcement of the rules as they stand now. So that's problematic. I think that the things that we're most tuned into and our members are most tuned into are those issues that normally we would get guidance from SEC staff on within investment management. Things like, what does material negative effect mean? So the requirement to disclose any preferential treatment or any preferential redemption rights or preferential disclosures of information has a material negative effect lens applied to it in the final rule. And certainly we anticipate that GP counsel, understandably, could take an excessively conservative view of that interpretation for compliance risk management reasons. And the other piece with respect to the terms agreed in side letters and what must be disclosed and what must be disclosed with advance notice to all LPs coming into the fund. Well, how is material economic defined? So in the absence of having clarity to those two key facets of the final rule, I think we are somewhat at the mercy of how the industry responds. All of that said, in talking to our members, I think that those LPs who are demanding certain things within their side letters because they are statutorily required, and I'm thinking in the case of California, John, AB 2833 and the fee disclosure requirement, we don't think that's in jeopardy. That would fall well outside of either material negative or material economic. And we believe that particularly in a challenged fundraising environment, which isn't softening anytime soon, so far as we can tell, LPs will continue to have some degree of leverage in what they're able to secure in their side letters. But I think it's also worth stating that there are things that LPs currently agree or LPs are able to secure an agreement from GPs and GP counsel within side letter that should really just be within the LPA. And John might even have examples of this. I don't know, things that Lacera has agreed to, but things like an interpretation of something in the broader document as relates to fiduciary duty obligations or disclosure of conflicts or how a conflict is defined. There are lots of things like that that end up getting expanded upon within a side letter where the benefit accrues to only a singular LP. So one of the benefits of all of this could be that those things become more commonly featured within the LPA themselves. But I'm sure John's got a take on all of that.
I want to do just that. Jen, thank you. I want to pull that thread with your help, John Grabel, a bit on this side letter implication or not that Jen is alluding to. We've mentioned you're a large public pension plan, I think the largest county pension plan in the US. So on the one hand, in a very, may I say, statutory box checking exercise, there are certain things in side letters that serve very critical legal purposes that you have to abide by. But going farther, one of the real standout phrases in your letter to the SEC was that something along the lines of side letters are a mechanism or a conduit for pushing and advancing innovation and new advancements in the marketplace that the standard LPA would not address, that is particularly important or has bespoke significance to, in your case, Lacera. So can you talk, building on what Jen said, a little bit about the importance of side letters when you think about your negotiations and then your ongoing relationship with your GPs?
Sure. And John, you mentioned Lacera being the largest county pension plan in the United States. We oversee just north of 75 billion or so, just to put that in perspective. And we do believe that our side letter, which is a heavily negotiated document, it's 20 plus pages, we're doing it as part of our duty of care, our duty of prudence, or duty of loyalty to our members. So we're doing it as fiduciaries for Lacera. However, there are benefits as it relates to pushing GPs. So maybe some benefits for the other LPs long-term in terms of advancing a dialogue. And an example could be in distributions, for example, where we will write in a side letter that we'd prefer that a GP, when they take a company public, not distribute the stock to us. The stock that they distribute, if they're distributing it to all LPs, maybe their carrying value and the distribution value may differ, and there's maybe some type of an accounting gimmick or fee issue or carried issue associated with that. So I think that's something that benefits all limited partners. Now, there's some aspects that truly are just for Lacera, where we'll negotiate the right to be on a limited partner advisory committee. But we think that oversight does benefit all limited partners, where a limited partner advisory committee does push the GP on valuation methodologies, on choice of auditors. So that's something that certainly is beneficial to LPs as a whole. And once again, I'm thinking this isn't as cogent a comment as Jen's. So I'll go back to things that may benefit others as a whole, may be a mechanism for a limited partner advisory committee to oversee, review potential conflicts. That has to benefit everyone. And the absence of that is not good for any LPs, nor is it good for the general partner, nor is it good motivation for the general partner to believe that they don't have to worry about potential conflicts of interest. But one other aspect, or several other aspects, include we put in our side letter an ILPA innovation as it relates to certain templates for fee reporting, for capital calls and distributions. That's something that benefits all LPs, and that's something that Jen can talk about, the origin of that. And one last thought, John, on this question relates to public markets, that we have a set of governance principles, investment beliefs that apply to all investments. To the extent that we pay higher fees, have blind pool risk, and have our capital locked up for decades, and if you look through those investments, we have higher proportional ownership of a company, for example. In some ways, the notion of having lesser insight, lesser governance capabilities, there's somewhat of a disconnect there.
Completely agree, John. And since you bring up the fees, I think we should drill down on that now. So by all accounts, it's perhaps the most universally supported element from LPs. It's the new regulation specifically on the detailed fee disclosure. In fact, it was listed as the number one most needed improvement from LPs in that recent ILPA survey. It seems like when we talk to people, and in my experience, there is some confusion and conflation and perhaps even a bit of obfuscation at times around what gets included in that management fee component, and then what also gets charged to the partnership, and what are the appropriate operating expenses that then fall into that bucket. Why is fee transparency so controversial? And Jen, this is directed at you, but John, I would also love your insights as well to the extent you want to add them, because it seems as though standardization would actually help improve the administrative burden around GP fee disclosures, but it seems like there's a lot of pushback. So help me out here.
Christy, it's a fantastic question. And there's no good answer for why it should be so controversial. I can certainly understand why people would have questions and concerns about how we define what requisite minimum transparency is, or how we define the components within expenses, et cetera. What do I have to provide, and how do I calculate that in a way that is consistent with how everybody else is calculating it? I get that, but that's the how, not the why. The opposition to providing transparency on a principle basis makes zero sense to me, makes zero sense to ILPA's members. So I'm not sure I can get into a rational discussion for why it's so controversial. I'll just share a couple of points of information. One, going back to what John Grabel mentioned a moment ago about ILPA templates. Since we released the first ILPA fee and expense reporting template in 2016, we have seen steady increase in adoption. And that's happened because LPs like Lacera have made that request, sometimes couched in terms of a requirement they have to satisfy, a statutory requirement, in the side letter. So they'll get it, but it's not necessarily being provided to all of the LPs in the fund. So even though we've seen adoption increase, we have continued to ask this question about, are you getting it because you push for it in the side letter, or are you getting it because the GPs are just providing it to you? And the majority still tilts to the former as for the mode in which it's being distributed. And that's really unfortunate. So I think one of the biggest wins that we could point to in this whole process with the PFA rule has been the establishment of a federal standard for what a minimum floor should be. One of the challenges I would point out, however, is that the final rule only speaks to fund level transparency. And we all know that not every LP comes into the fund under exactly the same terms as far as the amount that they've put to work or specific requirements that they have around, for example, fee offsets. So we've always advocated for that pro rata being disclosed to the individual LP, because maybe you have co-invest. Maybe you got a discount because you invested in multiple products from the same general partner. Maybe because you're a repeat LP, you got a slight discount. These are things that are all known. They're all fully transparent. Nothing is being hidden. And therefore, whatever fees and expenses you're ultimately being charged are to some extent a function of the relationship you have with a GP. Again, not because you've negotiated for some cut that nobody else knows about. This is all pretty standard stuff. So it's important that we don't lose that the cost of getting that minimum floor isn't that That is now the ceiling, and we've lost that hard-won disclosure that LPs have secured over many, many years. So I think that's an important distinction to call out in where things currently stand with the rule.
One, I share Jen's confusion. It's not really a complex ask, but it's a really important one. And in addition to what Jen said, one really important reason for Lacera, at least in terms of why fee disclosures matter, is succession planning, is risk management in our underwriting of a general partner. Over the last decade and over the next decade, many firms are going through generational change, are going from a founder to that next generation of managing the firm, and absent information about the economics within the organization, without it being disclosed, without understanding at the LP level, at the portfolio company level, at the fund level, what is happening really mitigates our ability to understand fully who's going to be running the firm and what those key person risks potentially are.
It was always funny to me too, because particularly in the private equity side, if you are operating businesses, I find it hard to believe that you couldn't get basic expense information about your own business. So I think once somebody put that perspective into my mindset, I remember thinking, okay, and then it made me realize I just have to ask. And more often than not, they'd be willing to offer it to me. But to everyone's point, it is odd to me that once you have it, why not just give it to everybody? But John, your team in particular, y'all have worked really hard to lower fees on behalf of your members. And it seems like you've done this in a number of ways, whether that be higher underwriting scrutiny, working access to co-investing, selective investing, things like that. Do you worry that some of these changes and the possible administrative burden of those might result in fees being passed on to you, or will this just be another element of due diligence?
I think it's another aspect of diligence, because the future is the future in the sense of we don't know what will happen, but we have to be prepared for multiple states. We've worked hard, not just in private equity, but across all types of illiquid assets and liquid assets for that matter, where we spend significant time investing through the right structure, be it a separate account, be it a dedicated managed account where we'll custody the assets ourselves, whether it be a co-investment, whether we'll be holding title to an asset in a direct investment. So I think that a consequence of this, and now going back to private equity, for example, or very pointedly, is this may force investors like Lacera that have traditionally invested in commingled funds to seek different methods and wrappers around private equity or real asset or other private types of investments where we can be proper stewards of our capital for our members. Because the one thing, if certain rights are stripped for Lacera, if we can no longer get certain terms, that means that the risks are higher for us. So we always want to make sure that we mitigate the risks and not just hope that, well, they had great returns in the past, they're going to have great returns in the future. That's just hope. And that's not a strategy for us. We need to really make sure that we're being compensated for the risks, and those risks are intentional.
And Christy, just to follow on what John said and to speak specifically to the costs, and will the costs of complying with this rule, if it's not vacated, fall on the shoulders of the LPs? Guess what? Those costs already fall on the shoulders of LPs. So I think that comes down to a point of negotiation. If you're an LP anchoring an emerging manager, for instance, you're going to have a lot more transparency into what it costs to run that firm and to run that fund. And you're probably going to be more willing to shoulder some of those costs. Whereas if you're investing, I'm not going to name names, but if you're investing in a $20 billion fund and you've invested in their last 5 funds, that might be a little bit less palatable. So I think it comes down to a point of negotiation, and the final rule landed on disclosure, not consent. So as long as it's been disclosed, it's not prohibited. And I think that's a continuation of normal course of business as it's been with LPs and GPs for quite some time.
Jen, as we move towards conclusion here, I want to zoom back out to negotiation generally, alignment generally. And Christy mentioned this great ILPA survey that, by the way, thank you, was an awesome source for our opening segment. And I would say that the seedling of a lot of these discussions in the previous years that has led to the PFA rule was this idea that while LPs, yes, particularly the big ones like John, for example, have grown more sophisticated in the broadest sense, that a lot of LPs think that the negotiating leverage or power has migrated, drifted towards the GP. And there's a whole lot of reasons that they cite for this: information asymmetry, consolidated legal counsel. You mentioned the loss of allocation threat, the power law, just elite GPs begetting more elite GPs. All of this we understand. None of it is necessarily a bad thing, but it has resulted in aggregate of this movement, as I said. Do you think this rule is going to help with that? And if it doesn't go far enough, what else do we need to level the playing field?
So the final rule, again, if not vacated, is going to provide LPs ostensibly with a lot more transparency around relative costs of their managers. And so when you're looking A to B, what does it cost to deliver those returns to me? How much am I giving up because of the fees and expenses that are being netted out? So hopefully that does have a bearing in the more informed decisions that LPs are making about which GPs they're going to bet on long term. But will it level the scales from a negotiating point of view? That's really tough to say, because structurally there are things about how these contracts are negotiated that do not have a regulatory remedy. They just don't. Concentration among the counsel who are negotiating these documents on behalf of the GPs, that is not something the SEC can engage on. And we know that is absolutely a factor in why the scales over the last decade plus have tilted in favor of the GP for various reasons. One being, when you have that concentration, what is market becomes really more about what is the form document for that particular firm. Market is influenced by the competitive intelligence that that firm has about you as an LP and what you have agreed to in other fund negotiations, completely unrelated fund negotiations, so that they have the information and they utilize that information. Those are things the SEC and this rule simply cannot respond to, and we recognize that. And the last thing I'd call out structurally that's a real challenge, besides the information opacity that we've talked about ad nauseum in our on-the-record commentary, is the fact that counsel negotiating on behalf of the fund is paid for by the LP. And yes, you can say, oh, that gets netted out in the waterfall. Well, double check your waterfall, make sure that's actually true. But counsel's fees are being paid by LPs. So as an LP, you are paying your own counsel and you are paying the legal costs up to a cap for the fund's negotiation. So these are some structural dynamics that really do put a thumb on the scale for which the regulator is not the cure. The industry has to determine whether we would like to cure ourselves and do something different and to innovate our way out of some of these structural challenges.
John, I want to give you the last word to develop or underscore what Jen said a bit further. Let's just say that hypothetically you could convene a summit in LA, right there in the Lacera offices, your own Davos. So you had the SEC and ILPA and CAIA and the GP trade groups all sitting in the room and all coming with an open-mindedness to find common ground. Is there one or two things on your agenda for standards, regulation, practice, whatever it might be, that you think would really move the industry forward towards putting investors' interests first?
I think everyone should always come to Los Angeles. So maybe that's where we start. It's a fantastic place to be all the time. I would add, John, one other group to this hypothetical summit. I think that consultants, whether they have discretionary or non-discretionary authority, I think that they speak for many limited partners. And I think it's an important voice that, I think we used the word before, agency. I think that it's a voice that potentially amplifies the agency of limited partners. So I would add them to the table. I think what issues would be on my list? I would maybe frame it slightly differently, that we have a discussion at the beginning about fiduciary duty, that why it is what we're doing and who it is that we're doing it for and what the role is. And a mentor of mine used to say, it is a privilege to manage institutional money. I think everyone has to recognize that that privilege exists, and it's an important entry discussion to have. And associated with that is, I think that this convening needs to be done with humility and grace. I think that there's way too much bravado in this discussion, not our discussion here, but in the discussion about why we can't do this or why we shouldn't do that. I think that we need to, once again, understand the framework and do it in a constructive way that recognizes that it's a complicated issue, but it's not a hard issue. And maybe, once again, I'm not giving you any direct answer of what those issues are, but I think that how we frame the discussion such that everyone wins, and I think it is easy for everyone to win.
I actually think that's great wisdom, John. I think part of the reason we wanted to launch this show was to provide more civil discourse, which is, as we've often said, a lost art, this idea of humility and balance, hence the whole decanting, to bring out the full body of all sides, if you will, and allow things to breathe a bit more. So killing the metaphor there, but I think you've reminded us that that's important. Let's start with table stakes. Why are we here? Why does this industry exist? What role do each of us as actors in this value chain play? And who is ultimately the beneficiary? So I think that's a fantastic and amazingly virtuous way to end. So John and Jen, you have been fantastic in bringing to life much of the information and content that Christy and I tried to introduce. It's one thing for us to do some research and offer a tutorial. It's a whole nother thing to talk to those that are in the trenches. So we are very grateful. Happy New Year to you both. And thank you so much for joining Capital Decanted.
Thank you.
Thank you very much.
Thanks, everyone.
Listeners, stay tuned for this edition of The Last Sip. Well, welcome back to the final sip. Christy, we're here having done all that research, having listened to Jen and John opine, educate us. Wow. I don't want to give away my final sip comments that I'll follow you with, but I'm not sure there was an episode we've done yet where my thoughts zigged and zagged, perhaps grew and then retracted and evolved as much as the process of creating this episode. But what were your biggest reflections? Where do you find yourself settling in after this topic?
I'm actually with you. I'm still zigging and zagging a little bit, as I said at the very beginning, or when it was just you and I on. I think where I'm coming down is just to reflect on the whole and say, when I speak to all the sides, they want to have a peaceful resolution to this. It doesn't seem as though when I talk to the individuals, it's combative. I can't speak for how the SEC is going to be, obviously, but I think that overall, it's a step in the right direction. I appreciate that everybody is mindful of it. And I think, I don't know, I will be curious to see how everything settles out, particularly with the lawsuit and as this goes into effect, because I definitely agree with John that transparency is paramount when you're a fiduciary investing on behalf of important missions or on behalf of people's retirements. And I appreciate that it is very front and center in the minds of LPs and that they still want to work with GPs to find solutions to meet their transparency needs and their fees and stuff. And ultimately, as the industry becomes more professionalized, as they demand access to retail and mass market affluent parts of the industry, these are things that they're going to have to sort out anyways. So might as well do it with the partners that they're used to and that are willing to be open and allow them their due, their flowers, if you will, as well. So what about you?
Well, let's just say this. Before about halfway through the question episode, the second segment with Jen and my momentary therapy session, I would have said that if you would have asked me to pick up words that describe my feeling on this whole thing, I would have chosen things like disappointment, deflation, as in being deflated. Because we've always been, CAIA's always been about improving LP-GP alignment. This is part of our identity and our mandate around client outcomes. At least initially, my thought was what's being exposed through this episode and this dialogue publicly is that there's a whole lot more misalignment than maybe I thought, that there is residue that still hasn't been cleaned up. Now, look, I understand all the actors on the value chain aren't going to agree on everything. And there is sharpness when you're in the midst of negotiating anytime. We all know that, whether you bought a house or, as I said on the earlier segment, bought a piece of software. But I will say that it's just not a good look. Our mudslinging down at the Fifth Circuit plays right into the ugly narratives parroted by some that I know is not true about our industry and all the good that it brings. And the very large majority of GPs and LPs, as you know, friends of mine, friends of yours that are trying to do the right thing, fueled by serving clients. but we just can't claim to be a profession or even aspire to be a profession with a social license to operate from the public when we're still talking in different stratospheres about things like disclosure and transparency and fairness. And I quoted Howard Marks earlier in saying that the pendulum will continue to swing. And maybe that's all this is. History is going to judge, as you rightly articulated, the PFA over lots of time. Some pieces will be tightened, others removed. But the whole thing is not a great PR opportunity right now. It's probably going to set us back a bit in the psyche of Main Street. So as you can tell, I'm dealing with my own disenchantment, deflation, while being encouraged by Jen that this is early and we're in the first round of this.
Absolutely. I think well said. And I think it'll get better. Always darkest before the dawn.
That's right.
Or so they say. I don't know.
I sound like I've got serious emotional issues here, so don't get me wrong.
I get it.
I'm just sorting through all of these elements. Well, listeners, the fun question we picked, as we always do, was to share a memorable travel experience that left a lasting impression on you. Our goal here is to allow you to understand a little bit of who we are as hosts beyond the topic du jour. So, Christy, would love to hear about your travel experience.
So I have had some really great ones, but I have to say India was at the top of my list. So probably about 9 or 10 years ago, I had the opportunity to tag along on a 10-day trip where flew into Hyderabad, ended up going up through New Delhi, obviously seeing Taj Mahal while there, back down, and then through Mumbai. And it was just the most amazing trip because I can't even describe it. And just the ability to go see all of these really amazing places that were on the other side of the world for me. And just the people were so nice and welcoming. The food was amazing. I cannot underscore that enough. I really think that it's such a wonderful country. And I would love to go back and actually visit more of the east coast of the country there. It's very American of me to be like, oh, I landed in 3 cities. And so I checked the country off. So yeah, I definitely want to go back and explore and maybe go down to Goa and just really experience all that the country has to offer. And then I would say honorable mention was I took my daughter to Tortola during the pandemic and they were only letting 100 people in every day. And it was amazing.
Wow.
Walking onto a beach where there's maybe 2 other people and having this amazing, glorious white sand beach and blue water, feeling like you're on a deserted island. It was very cool. What about your travel experience?
Awesome. So you stole India because I could have clearly talked about my first trip to India too, which is just a sensational experience in all things, in all the senses. And it had a huge impact on me, on my character. But since you took that,
I'm sorry.
I'm going to say my first trip to Asia it was early 1998. So I'm going back a little bit here. So this is just to paint the picture and remind us all, this is Hong Kong less than a year after the handover.
Wow.
And by the way, also maybe more towards the end, but still the whole Asian-Russian meltdown was still occurring, if you remember that, reverberating through the region. And I went to the CSFB Asian conference because at the time I followed global technology and consumer products as an analyst at SSGA. And back then, if you're old enough to remember, CSFB and the CLSA events were the only shows in town. They were annual events. They were attended by everybody. Anchor conferences. So you had companies, analysts, investors, celebrities. And the CSFB one ran in concert with the Hong Kong Sevens, the huge global rugby event. And I was just smitten with Hong Kong and Asia from the very beginning. So quarter century later, the region has just continues to arrest my wonder and the vitality, the winding history, the colorful cultures, the amazing foods and flavors, and countless trips. I've created friendships, cultivated a more informed understanding and empathy for the world's economic and geopolitical blocks. And as you know, but many listeners might not, ended up adopting our youngest 2 children from that part of the world. And this was all a journey for me. So my 14-year-old daughter is from Korea. My 13-year-old son is from China. So it is a special place for the Bowmans especially, but it's a special place on an absolute basis. And it changed me and my family forever.
I love that. And that's a region I feel like I need to explore more. I've been to Japan, but I have some friends who are living, one in Taiwan, one in Hong Kong right now. And so I'm like, oh, I need to get over there. So I'll have to get your recommendations when I finally get the opportunity. It's very cool.
Proud Asian dad. So happy to help.
That's awesome. I love that.
Well, Christy, this has been fantastic. Listeners, I hope you have stuck with us and appreciated the information and the journey. And we look forward to seeing you next time on Capital Decanted.
Thanks so much.